When most people think about Roth conversions, they focus on whether a conversion will reduce the taxes they'll pay over their lifetime. And to be clear, that matters, but it may not go far enough. And here's why. When you convert money from a traditional to a Roth IRA, you're making a very specific choice. You're choosing to pay taxes now at known rates on your timeline and using your assets. The alternative is to leave that money in a traditional IRA, defer the tax, and deal with it down the road. And if you don't deal with it, someone else will. Usually your spouse first, and eventually your kids. But almost always under rules and tax rates that you don't get to control. And as most people know, traditional IAS don't eliminate taxes, they defer them. And guess what? Deferred taxes don't disappear when you do. They get passed along. So if you die first, your spouse becomes a single tax filer in the next year, but still has the obligation to take required minimum distributions, often at much higher tax rates. That's what people refer to as the widow's penalty, and I've covered that in detail in another video. But after your spouse is gone, your children generally inherit what's left. And under current rules, most non-spouse beneficiaries are required to fully drain inherited retirement accounts within 10 years. That means forced income, often during their highest earnings years, stacked on top of their salaries, bonuses, and all of their other income. In other words, the tax bill that you don't want to pay now, it doesn't go away. It just changes hands, and in many cases, it gets significantly larger. So, once you've reached the point in your planning where you know that you're going to have enough to live on, and it's becoming clear that there's likely going to be some money left over, it's time to sharpen the pencil and ask the real question that actually matters in the end. And that's after all the taxes are paid by you, by your spouse, and eventually by your children, how much of this money ends up in your family's hands and how much ends up going to the IRS. Now, if you want to look at it this way, you're going to have to expand how you think about Roth conversions and extend the planning horizon beyond just your own lifetime. You have to include your kids. And if you're like most retirees, there's a decent chance that your tax rate today is lower than your children's will be in the future. Now, that's certainly not guaranteed, but it's highly likely for a lot of retirees, especially if your kids are successful dual income households or they own a business of some sort. Now, when you look at Roth conversions through that lens, the decision changes. Even a conversion that looks neutral or slightly unfavorable over your lifetime can make a lot of sense when you extend the planning to the next generation. So, let me show you an example of a real plan. Now, I'm not going to get into all the numbers that went into this, but we don't have to for us to see pretty quickly how big of a difference expanding the planning horizon can make. So, first, let's look at the plan without extending it to the next generation, just the husband and wife, and the total taxes they'll pay over their lifetimes. Now, there are a few moving parts in their plan. So you'll see that the tax line isn't perfectly smooth from year to year, but hey, that's true of almost every real-world plan that we've done. So this orange line is what they would pay in total cumulative taxes if they did not do a Roth conversion, and this blue line is what they would have converted up to the 24% bracket, the amount of taxes they would have paid. Now, you'll probably look at this and come to the same conclusion that they did. Well, the Roth conversion analysis, just based on their total lifetime taxes alone, is neutral at best. You know, in the early years, taxes are clearly higher with conversions when they're intentionally accelerating the tax payments, and you could see that show up immediately. But over time, that gap narrows, but it never really turns into a big win during their lifetime. And if all you're trying to do is minimize taxes while you're alive, you could reasonably look at a chart like this and say, why bother with it? You know, the no conversion scenario doesn't look meaningfully worse. In fact, depending on how you frame it, it might even look slightly better. So, if you end the analysis here, you'd probably conclude that, well, Roth conversions aren't really all that compelling. They don't dramatically improve the outcome for retirees, and at best, they're just kind of a wash. But this is also where the analysis is incomplete. Now, let's extend the planning horizon and add their daughter into the picture. In this plan, both parents pass away at age 95, and she inherits the remaining retirement assets. Now, she's doing well financially, and the distributions from the IRA would all be in the 35% tax bracket. And when we run the numbers this way, the difference becomes very clear. In the no conversion scenario, cumulative taxes just keep climbing. After the parents are gone and the daughter is forced to distribute that inherited IRA at high tax rates, total taxes paid across the entire family exceed $3.8 million. Now, let's look at the same plan except where the parents converted up to the 24% tax bracket. Now, the daughter no longer has large taxable inherited IRA assets to drain, and she still has to follow the 10-year rule, but now the distributions are mostly tax-free. By the end of the projection, total cumulative taxes under the Roth conversion scenario are about $1.6 million. So, in this case, strategic Roth conversions reduce the total taxes paid by more than $2 million. So, when you stop the analysis at just the parent's lifetime, the Roth conversions look neutral. But when you extend the timeline and ask how much money actually ends up in the family's hands, the difference is dramatic. And that's why Roth conversions aren't just a tax strategy, they're a legacy decision. And if your analysis doesn't include at least a conversation about what happens after you're gone, it probably isn't complete. Now, look, this isn't important to everyone, and I get that. Some people will say, well, look, if the worst thing that happens is my kids inherit money that's going to make them pay a lot of taxes, they'll still be better off financially and better off than I was. I get it. That makes sense. But then other people will look at this and say, well, I'd rather my kids get as much as they can instead of the IRS. I've even seen some cases where the kids have proactively offered to pay the taxes on the conversions because they know what's coming down the road. Now, there's a lot of factors that go into good Roth conversion decisions, like, your cash flow, Medicare premiums, Social Security taxation, how much to leave in the IRA for long-term care or charitable giving, what kind of market returns can you expect, what's tax law going to do in the future, what kind of estate planning goals do you have, what are the ending tax-adjusted balances. There's a lot, right? So, this example isn't meant to say that everyone should convert or that conversions always reduce taxes. It's meant to show that if your analysis stops for your own lifetime, you may be missing one of the most important pieces of the decision. And if you'd like help analyzing whether this decision makes sense for your situation, there's going to be a link down below where you can schedule a conversation. We can walk through it together. Thanks for watching.